Have you ever felt like you're throwing money into the market without really knowing where it's going? The wealthy don't rely on luck. They invest with mindset, analysis, and discipline. Based on insights from successful billionaire investors, we'll break down every corner of investing, from reading financial statements, valuing stocks, to building a smart portfolio, all explained clearly and simply, even for beginners. If you're truly serious about mastering your finances and investing strategically, this video is the textbook you can't afford to miss. Part 1. Long-term investment mindset. The core of successful investing. 1. The importance of long-term thinking. The short-term market is driven by emotion, but the long-term market is driven by logic. Short-term price fluctuations often do not reflect the true value of a business. Successful investors like Warren Buffett always emphasize, buy a stock as if you're buying a piece of a business. 2. Think like a business owner, not a gambler. When you own a stock, you're actually owning part of a company. So every investment decision should be made with the mindset of a co-owner, not just someone speculating on price swings. 3. Why beginners often fail. Most new investors are influenced by the media and market noise, lack a clear investment strategy, react emotionally to price movements. This leads to the classic mistake, buying high and selling low due to fear or greed. 4. Business value matters more than stock price. Gerard. Do highlights. Price is what you pay. Value is what you get. Stock prices fluctuate based on supply and demand, but the intrinsic value of the business is what truly matters. 5. Successful investing equals patience plus discipline plus knowledge. You don't have to act constantly. Sometimes doing nothing is the best action. Great investors aren't those who predict the market perfectly, but those who hold strong companies patiently over time. Invest with a long-term mindset, as if you are buying a real business. Don't let emotions dictate your decisions. Focus on understanding true value and trust your strategy. Part 2. Fundamental analysis. Evaluating the true value of a business. 1. Purpose of fundamental analysis. Fundamental analysis helps you understand the financial health and long-term potential of a business, beyond just stock prices. The goal is to determine whether the company generates sustainable profits, has stable cash flow, and possesses real growth drivers. 2. Key financial elements. Revenue indicates a company's ability to sell products/services and grow market share. Net profit, the actual profit after taxes, reflects business efficiency. Free cash flow, cash left after operations and capital expenditures used for reinvestment or dividends. Profit margins, profit as a percentage of revenue. Higher margins suggest strong competitive advantages or cost control. 3. The 3 key financial statements. Balance sheet shows a company's assets, liabilities, and equity, reflects financial strength. Income statement details a company's performance, revenue, expenses, and net income. Cash flow statement breaks down cash flow from operations, investing, and financing. Focus especially on cash from core operations. 4. Common valuation ratios. These help you assess whether a stock is overpriced or undervalued. PE, price to earnings. Stock price divided by earnings per share. Compare to industry average and historical values. PB, price to book. Market price divided by book value. Useful for asset-heavy companies like banks. EV/EBITDA, enterprise value divided by earnings before interest, taxes, depreciation, and amortization. Shows operating profitability. 5. Beyond the numbers. Qualitative factors. Management quality. Does leadership have vision, transparency, and strong execution? Competitive advantage. Does the company have a moat, a long-term barrier protecting its market share? Hidden risks, high debt levels, dependence on a few customers, industry volatility, etc. 6. Conclusion. Why fundamental analysis matters. Fundamental analysis lets you approach investing like buying a real part of a business, at a price that reflects its true value, not just emotional market trends. Fundamental analysis means understanding the true health of a business, using financial reports, valuation metrics, and strategic insights, so you can invest wisely, with confidence, and not just based on stock price movements. Part 3. Sustainable business model. Building lasting competitive advantages. 1. Understanding the business model. A business model explains how a company makes money, including its product or service, target customers, and revenue generation strategy. Evaluating it involves asking, who are the main customers, and what problem is being solved? What is the value proposition? Low cost, premium product, convenience, or innovation? How scalable is the model as the company grows? 2. Identifying a competitive moat. A moat refers to structural advantages that protect profits and market share over the long run. Examples include brand strength, trusted brands like Coca-Cola or Apple; network effects, platforms like Facebook or Amazon that become more valuable as users grow; cost advantage, companies like Walmart that benefit from economies of scale; switching costs, products or services like ERP systems that customers hesitate to leave; intellectual property, patents, proprietary technology, or trade secrets. 3. Evaluating sustainability. To assess whether a business model is sustainable, check if revenue and profits have consistently grown and if gross margins remain stable. Understand how management plans to reinforce the moat through innovation, partnerships, or strategic investments. Investigate potential threats, new technologies, regulatory changes, or rising competition. 4. Avoiding fads and trendy businesses. Seasonal or trendy companies, e.g. viral app startups, may attract quick investments but often lack long-term resilience. Well-rounded businesses solve real customer problems, generate repeatable and predictable revenue, have the ability to innovate and stay ahead of disruption. 5. Qualitative assessment tips. Customer loyalty. Analyze retention rates, repeat purchase behavior, and review trends. Pricing power. The ability to raise prices without losing market share indicates strong brand and moat. Management vision. Commitment to innovation, capital discipline, and long-term goals. 6. Conclusion. Why it matters. A sustainable business model with a moat ensures that your investment isn't just driven by market trends, but anchored in lasting value creation. Part 3 guides you to evaluate how businesses make money long-term, by understanding their core operations, identifying long-lasting competitive advantages, and steering clear of hype-driven, unsustainable plays. Part 4. Stock valuation. Determining what a business is really worth. 1. Why valuation matters. Valuation helps you answer the most important investing question. Is this stock worth the price I'm paying for it? A great company can still be a bad investment if you overpay. Likewise, a mediocre company might be a good investment if the price is deeply discounted. 2. Common valuation methods. A. Price to earnings, PE. Ratio formula, price per share, earnings per share. Indicates how much investors are willing to pay for each dollar of earnings. A high PE may mean the stock is overvalued or investors expect high growth. A low PE may indicate undervaluation or trouble ahead. Compare with industry peers. Company's historical average B. Price to book, PB. Ratio formula, market price, Book value per share. Shows how much you're paying relative to the company's net assets. Useful for asset-heavy industries like banks, insurance, or manufacturing. C. EV/EBITDA. Enterprise value. Earnings. Before interest, taxes, depreciation, amortization. A more complete valuation metric than PE, as it includes debt and cash. Good for comparing companies with different capital structures. Lower EV/EBITDA may suggest undervaluation. D. Discounted cash flow, DCF. Projects. Future free cash flows and discounts them back to present value using a required rate of return. DCF is more accurate but relies heavily on assumptions, so it's sensitive to errors. 3. Relative versus intrinsic valuation. Relative valuation. Compare metrics like PE or PB to similar companies or industry averages. Intrinsic valuation. Focus on what the business is truly worth based on cash flows or assets, regardless of market sentiment. 4. Red flags to watch. Extremely high valuations without profit, e.g., speculative tech stocks. Valuations driven by hype, not fundamentals. Accounting manipulation. Always double-check the numbers behind the ratios. 5. Combining valuation with fundamentals. Valuation isn't just about finding cheap stocks. It's about finding quality companies at a reasonable price. Combine valuation with business model strength, competitive moat, consistent profitability. A stock's price isn't the same as its value. Valuation helps you determine whether you're getting a good deal or walking into a trap. By using metrics like PE, PB, EV/EBITDA, and DCF, investors can identify smart opportunities and avoid emotional overpaying. Part 5. Risk management and portfolio construction. Protecting capital while growing it. 1. Why risk management is crucial. In investing, return is what you aim for. Risk is what you must control. Even the best investment idea can hurt you if you take on too much risk, bet too big, or ignore volatility. Successful investing is not about avoiding risk, but about understanding and managing it. 2. Types of investment risks. Market risk. Overall market downturns that affect all stocks. Company-specific risk. Business failures, fraud, earnings decline. Liquidity. Risk. Difficulty selling an asset without significant price loss. Currency. Risk. For international investments. Interest rate risk, especially for bonds or high-debt companies. 3. Asset allocation. Your first line of defense. The mix of asset classes in your portfolio, stocks, bonds, real estate, cash, determines over 90% of long-term returns and volatility. Younger investors may prefer equity-heavy portfolios for higher growth. Older investors may prioritize stability and income, leaning toward bonds or dividend stocks. Diversification across sectors, countries, and asset types helps reduce shocks. 4. Position sizing and diversification. Position sizing. Don't put too much capital into one stock no matter how confident you are. Diversification. Spreading your capital across 10 to 20 quality companies or assets reduces the impact of one bad pick. Avoid over-diversification, which leads to index-like performance with active effort. 5. Having a margin of safety. Coined by Benjamin Graham, this concept means buying stocks at a price below their intrinsic value. This provides a cushion if things go wrong. It's your buffer zone in uncertain markets. 6. Emotional risk. Often overlooked greed during bull markets and fear during crashes lead to poor decisions. Build rules-based systems like rebalancing, stop-loss, or investment checklists to stay rational. Avoid trying to time the market or chasing trends. 7. Rebalancing and review. Periodically review your portfolio and rebalance to maintain your risk profile. Sell overweight winners, add to undervalued laggards, unless fundamentals have changed. Managing risk is just as important as picking the right investments. A solid portfolio balances opportunity and protection. With asset allocation, diversification, and emotional discipline, you build not just returns, but resilience. Part 6. Common mistakes to avoid. What most investors get wrong. 1. Chasing hype and trends. Jumping into hot stocks or sectors without proper research is one of the most common traps. Just because something is trending, like crypto, AI, meme stocks, doesn't mean it's a good investment. Many people buy high out of FOMO, fear of missing out, and sell low out of panic. If everyone already believes in the story, you're probably too late. 2. Overtrading and market timing. Trying to time every peak and dip leads to high transaction costs, increased emotional stress, missed long-term compounding opportunities. It's nearly impossible to consistently predict market moves. Time in the market beats timing the market. 3. Using too much leverage. Borrowing money to invest can amplify both gains and losses. A small market drop can wipe out leveraged positions. Risk of margin calls and forced selling in downturns. Unless you're highly experienced, avoid or limit leverage. 4. No clear strategy or plan. Many investors lack a defined investment strategy. Follow random tips, news, or social media. Don't know why they're buying or selling. Without a plan, it's easy to react emotionally and inconsistently. Your portfolio becomes chaotic instead of goal-oriented. 5. Ignoring the business behind the stock. Treating a stock as just a ticker symbol or number, instead of part of a real business, leads to poor judgment. Always ask, what does this company do? Is it profitable and growing? Would I want to own this business in real life? 6. Letting emotions drive decisions. Greed makes you hold losers hoping they'll bounce back. Fear makes you sell winners too soon or avoid good opportunities. Emotional decisions are usually the opposite of smart investing. Creating a rules-based approach reduces emotion-driven errors. 7. Not understanding risk tolerance. Some investors take more risk than they can mentally or financially handle. Result? Panic selling during downturns, abandoning their long-term plan. Know yourself. What level of risk can you truly live with? The biggest investing mistakes aren't about picking the wrong stock. They're about mindset, behavior, and lack of preparation. Avoid hype, be patient, stick to your plan, and treat investing like a disciplined craft, not a guessing game. Part 7. Choosing the right investment style. Aligning strategy with your personality. 1. One size doesn't fit all. There is no universal strategy that works for everyone. The best investment style depends on your risk tolerance, your time horizon, your personality, and emotional discipline. How much time and effort you want to put into research. Successful investing isn't about finding the perfect system. It's about finding the right system for you. 2. Common investment styles. A. Value investing. Focus. Buying stocks that are undervalued based on fundamentals. Inspired by Benjamin Graham and Warren Buffett, requires patience and discipline to wait for the market to recognize value. B. Growth investing. Focus. Companies with rapid earnings revenue growth. Common in sectors like tech, healthcare, innovation. Valuations are often higher, with expectations of future expansion. C. Dividend investing. Focus. Companies that pay consistent and growing dividends. Attractive for long-term income and reinvestment. Often involves blue-chip or utility-type companies. D. Index investing. Passive investing. Focus. Buying entire markets through ETFs or index funds. Low cost, low effort, great for most people over the long term. Based on the idea that you can't beat the market, so just own it. E. Speculative. Thematic investing. Focus. High risk, high reward trends, e.g., crypto, AI, EVs. Can be exciting but dangerous if not researched carefully. Best kept to a small portion of your portfolio. 3. Active versus passive. Know your role. Active investing. Picking stocks, timing markets, deep research. More effort, more risk. Passive investing. Letting the market work over time. Simpler, consistent, lower stress. Many successful investors use a hybrid approach, combining both. 4. Matching strategy to your life. Are you young with decades to invest? You can tolerate volatility and pursue growth. Are you retiring soon? Prioritize capital preservation and income. Don't follow strategies that keep you up at night. Peace of mind matters. 5. Track and adapt. Monitor what's working for you. Be open to evolving your style as your life, goals, and the market change. But don't flip-flop too often. Consistency beats perfection. The best investment strategy is one you understand, believe in, and can stick with, even during market turbulence. Whether it's value, growth, dividends, or indexing, the key is to align it with who you are and stay disciplined. Part 8. Rebalancing and emotional control. Staying on track through all market cycles. 1. Rebalancing. Keeping your portfolio aligned. Over time, your portfolio drifts as some investments grow and others lag. Rebalancing is the process of adjusting your asset allocation back to your original target. Example: if you started with 70% stocks and 30% bonds, and stocks outperform to become 80%, you may want to sell some stocks and buy bonds to return to your plan. Why it matters? It helps lock in gains from outperformers, prevents overexposure to risky assets, keeps you disciplined and consistent. 2. Emotional control. The real test of an investor. Markets go through ups and downs, often irrationally. What separates winners from losers isn't IQ, it's emotional stability. Common emotional traps. Fear during crashes, selling at the bottom, greed during bull markets, buying too high. Regret, obsessing over missed opportunities. Overconfidence, taking too much risk after short-term success. Your biggest enemy in investing is not the market, it's your own mind. 3. Build a system, not just opinions. Have a written investment plan. Use rules for entry, exit, and rebalancing. Journal your decisions and learn from your wins and losses. 4. Think in decades, not days. Wealth isn't built overnight. It's grown through consistency, patience, and compound interest. Legendary investors don't panic during volatility. They stay the course, focus on fundamentals, and trust the long-term process. Final words. The journey begins with discipline. You don't have to be a genius to build wealth, but you do need a plan, patience, and the courage to stick with it when it's hardest. If you've made it this far, you're already ahead of 90% of the crowd. Now it's time to apply what you've learned and take control of your financial future. Like what you've learned? Don't forget to subscribe to the channel, give this video a thumbs up, and hit the notification bell so you never miss a new episode. Your journey to smart, confident investing starts right here, and we're here to walk it with you.